After earnings on the 29th of October, PayPal was down by as much as 7%, although they did recover quite well during the day, and since then they have been trading at about $79 per share. Today the company is down by another 3.24%, equaling to a total decline of 7.40% over the past 5 days, and year to date they are up by 25.97%. Now, the reason why PayPal shares fell as much as 7% on Tuesday after reporting earnings is for the fourth quarter, PayPal is calling for low single digit growth, while the analysts were expecting a growth of 5.4% to $8.46 billion in revenue. PayPal also reported a net income of $1.01 billion, which was slightly lower than the $1.02 billion reported a year earlier. The reported revenue was lower by about $4 million compared to the expected revenue of $7.89 billion, while the earnings per share were quite higher than the expected earnings per share of $1.07. To put this into perspective, the earnings per share were beaten by 12.16%, while the revenue fell by only 0.55%. So is PayPal being unfairly punished? Let's see what they reported in their quarter 3 earnings. The total payments value is up by 9% year over year. The revenue is up by 6%, so this is the low digit growth that the markets didn't like. The transaction margin is up by 8%, up by 6%. The earnings per share is up by 22%, and the free cash flow is up by a whopping 31%. So really the only thing that the markets didn't like was the low year-over-year revenue growth of only 6%. Now jumping over to our stock valuation spreadsheets, I will plug in the ticker PYPL for PayPal and wait for all the metrics to show up. And here I want to have a look at Pillar 3, Pillar 4, and Pillar 5 and look at the revenue, net income, and free cash flow growth of PayPal over the past 5 years. So we can see that over the past 5 years, the revenue has been growing at about 12.26% every single year. So indeed, the year-over-year revenue growth is lower than the average revenue growth over the past 5 years. But overall, their revenue growth is very, very strong. Now, if we jump over to the net income growth over the past 5 years, we can see that on average it has been growing at a rate of 21.59% every single year, growing from about $2.5 billion in 2019 to $4.25 billion in 2023. And again, the year-over-year net income growth seems to be lower than the average year-over-year growth over the past 5 years. And finally, to the free cash flow growth over the past 5 years, the average free cash flow growth is sitting at 7.48% year over year over the past 5 years, while year over year the free cash flow grew by about 0%. So we can see that the low growth this year in these three areas might be the reason why the markets are downgrading PayPal. Their active accounts grew by only 1%, which is quite lower than some of their competitors. Their monthly active accounts grew by 2%, though the number of payment transactions grew by 6%, the transaction per active user grew by 9%, and the unbranded card processing grew by 5%. So we see that PayPal is growing slowly but steadily. If we have a look at their guidance for quarter 4, we can see that they do indeed project low single-digit growth in revenue, and that they project lower earnings per share than in quarter 3, so approximately $1.03 to $1.07 per share. A company's earnings per share are always based on its PE ratio. And so if we jump to our stock valuation spreadsheets, we can see the PE ratio over the past 5 years. And we can see that this PE ratio has on average been decreasing at a rate of 18.68% every single year. So 5 years ago it was sitting at 37.62 and currently it is sitting at 18.42. And the lower the PE ratio, the higher the earnings per share. And so if they carry on with decreasing their PE ratio, their earnings per share will go up, which they are currently doing. A similar metric to the PE ratio is the price to free cash flow. And over the past 5 years, the price to free cash flow was sitting at 31.03, and currently it is sitting at 20.25. So PayPal has been decreasing their price to free cash flow as well as their PE ratio. Another important metric to evaluate is a company's share repurchases. And in the fourth quarter of 24, PayPal isn't planning on repurchasing any shares. But if we jump to Pillar 7, we can see that over the past 5 years, they have been repurchasing shares at a rate of about 3.05%, and year over year they have repurchased 9.11%. And as PayPal has been trading quite low compared to its historical values, it is nice to see that they have repurchased a lot of their shares outstanding. The reason why many analysts are bullish are mainly the growing partnerships with, for example, Shopify, Fiserv, and mainly Amazon. A partnership with Amazon is also why some analysts are bearish about the company, saying that the profit margin would decrease as Amazon would likely dilute PayPal's earnings per share. Analysts are also bearish as they fear the growing competition. But if we have a look at the analyst forecast, we can see that PayPal is currently a moderate buy with 16 buy ratings, 16 hold ratings, and 0 sell rating with an upside of 4.26% or $80.25 per share. If we go to the company's financials, we can also have a look at their debt to asset ratio. But rather than this, we like to use the long-term liabilities over the 5-year free cash flow negative dividends to be below 5. And as PayPal doesn't pay out any dividends, this will be quite easy. So the reason why we like to have a look at this metric is to figure out whether a company generates enough free cash flow to cover for all their long-term liabilities. PayPal has been increasing their long-term liabilities at a rate of 14.11% every single year, though they have also been increasing their free cash flow at a rate of 7.48% every single year. And so the long-term liabilities over the 5-year free cash flow is sitting at 0.57, which means that they can pay off all their long-term liabilities in about 2.5 years, which is amazing. This means that they won't get into issues with debt and will have a lot of free cash flow to push into innovation, buy back shares, or at some point start paying a dividend. And now we can finally jump to calculating their intrinsic value. And first we will use the Graham's formula revised. And here we will plug in the earnings per share, the base PE, the 5-year growth estimate, the growth rate multiplier at 1.5, the average yield of A corporation bonds, and the current yield of A corporation bonds to get an intrinsic value of $74.17, which is 4% lower than the current trading price. Now jumping to our second valuation model, the discounted cash flow model. And here I will plug in the free cash flow over the past 5 years and calculate the average growth rate to be sitting at 9.35%. The analysts project a growth rate of 8.30%, and I will project a growth rate of 10% into the next 10 years or so. After that, I will calculate the future free cash flow over the next 10 years, and using the discount rate, which I will plug in at 9%, I will calculate the present value of that future free cash flow. And adding all of that up, adding cash and cash equivalents, subtracting total debt, I will get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $99.01, which is quite higher than the current trading price of the company. Next, we want to see how they compare to their competitors. So we will jump to the multiples valuation. And here we will compare PayPal's earnings per share to the earnings per share and the PE ratios of its competitors, so Fiserv and Global Payments. We will take these companies' current stock prices and divide by their earnings per share to get their PE ratios, which we will average out and multiply by the earnings per share of PayPal to get an intrinsic value of $122.39, again quite higher than the current trading price, showing us that PayPal might indeed be undervalued compared to its competitors in its sector. Now normally we would have a look at the dividend discount model, but PayPal doesn't pay out any dividends, so we'll jump straight to our ultimate valuation, where we will average out the 3 valuation models we just did and get an intrinsic value of $98.52, almost $100 per share, which is 27.56% higher than the current trading price. And if we plug in a margin of safety of 20%, which is quite a high margin of safety, we will get an acceptable buy price at $78.82. Now, if I plug in a margin of safety slightly lower, say 15%, I will get an acceptable buy price at $83.75. With all transparency, I'm a long-term investor into PayPal, and I've been holding it for a few years now. And during those years, I've seen great returns. I hope that you found this video informative, and if you did, make sure to leave a like and let me know down in the comments which company you'd like me to evaluate next. And with that, thank you for watching.